When I was growing up, the limit of my financial education was my parents telling me to buy only things I can afford in cash. Looking back, this was a huge life lesson, and it probably has shaped my relationship with money to this very day. I always had the voice of my dad in the back of my head guiding me on any significant purchase. And even in business, we rarely took on any debt. If we couldn't afford something in cash, we just didn't buy it. Well, until we could. But most people don't think like that. The reality of life today is that we have access to nearly unlimited sums of credit, and if we want something now, we can generally buy it at a moment's notice and with little friction. And that's regardless of whether or not we can actually afford it. This is normal, not because it's right, but because everyone else is doing it. Money habits like this are stopping people from getting out of debt or building true wealth. And that's the purpose of today's video. In my view, there are 9 normal money habits keeping you poor. Most people are making these mistakes without even realizing it, and today I'm shining a light on each of these to help you tackle them head on. And if you recognize yourself in any of these scenarios, good, that's a sign to take action. Before we get into the video, if you like any of my content, please like this video, subscribe to my channel, and share it with somebody else that you think might benefit from it. Also, I'm now opening up a very limited number of personal financial coaching sessions over the next few months. If you want to get your finances fit for summer, then check out the link in the show notes below. Appearances matter, and in a world where trying to look healthy and wealthy is a norm, many of us will get caught up in all of the hype. Fancy cars, big houses, and extravagant lifestyles all come at a cost. Living the Kardashian lifestyle and being able to afford it are 2 very different things. Don't worry, I hear you when you say, "Oh Connor, I worked hard, I'm entitled to enjoy myself." And I agree with you. I have nice things, and I too have spent the money that I've earned on luxuries. I'm not for 1 minute telling you to stop spending, that's actually for a different video, but I always budgeted, and I ensured that I was never getting into debt or sacrificing my future for anything I bought. And if you can confidently say that as well, well then by all means, spend away. Don't go broke trying to look rich. A few likes on your Instagram story may give you a dopamine rush for a minute, but in the real world, it means less than nothing. And just because your neighbour bought a Tesla, got new windows, or has added an extension, doesn't mean that you have to. It's normal to want more in life. We all do. And we are bombarded with advertising, TV shows, and influence from every direction, enticing us to spend more with the aim of being happier. But I'll be honest with you, buying things won't make you happier. Not in the long term, and not when it comes at the expense of your future. Being content with what you have, and realising that early on in life, will help you to break free from one of the most influential negative money habits that will keep you poor. Even those of us who aren't caught up in the millionaire lifestyle suffer from increased spending. It's called lifestyle inflation, and it happens with little thought on your part. As our lives mature, we buy a home, families grow, and without intentionally planning to spend more, our costs increase. As your income increases, you might decide to spend a little bit more on memberships, subscriptions, or other living costs. It's normal to spend more when you have more, because that's what normal people do. But what happens when the money stops coming? If you're living to your means, it's unlikely that you're putting enough money away for your future. What would happen if you lost your job or you were unable to work? How would you afford this lifestyle in retirement without saving enough now? Most people don't realise that drawing down your pension in retirement comes with the most significant pay cut you'll ever have. Think about this. If you're spending 90% of your income now and saving 10%, could those savings ever grow to replace your current income? The answer is yes, but it would almost guarantee that you need to work into your 70s having started investing in your 20s. So in reality, the answer is no. The answer to lifestyle inflation is of course to manage your budget. And this brings me to my second money habit keeping you poor. Budgets are the cornerstone of financial success. I say this because it's absolutely true. So few of us manage our budgets beyond checking our bank balance mid-month and realising we're running short before our next payday. Budgets are not sexy, and budgets are not cool. But by not tracking your finances, you're leaving everything up to chance, and that will keep you poor. Is that sexier? I don't think so. It's good to remember that budgets are always forward-looking. They will shine a light on your finances and keep you focused on the plan for your money. And I don't really mind if you track everything down to the last penny or you loosely understand your spending habits, as long as you review these each month and make changes where necessary. There are 2 stages of life when it comes to budgeting. 1, keeping your spending less than your income, and number 2, increasing the amount of money you can save, invest, or pay down debt. If you spend more than you earn, you will stay poor forever. Going into debt should be avoided at all costs, and starting to budget will identify the reasons for this, and that will allow you to take action. When we build a budget that allows us to stay out of debt, we achieve a level of financial stability, a platform that will allow us to start putting our money to work in our favour. In our second stage of budgeting, our goal should always be to increase the percentage of our income that we can save and invest for our future. Aiming for a 20% savings rate is achievable for most people, though it wouldn't be without some sacrifices. 50% will virtually ensure you live as you do now in retirement, possibly a lot better. So far in this video, I've talked about lifestyle creep, and I've also talked about budgeting, but you could also increase your savings rate to an extreme level by earning more money. And funnily enough, this is the third money habit that's keeping you poor: only having one source of income. If you've watched any of my videos before, well, firstly, thank you. And secondly, you'll probably understand that I believe that business and entrepreneurship is the quickest and most effective way to achieve financial independence. I have absolutely no issue with you being employed and building wealth in a normal 9 to 5, and I've spoken to many people who have achieved significant financial success through doing just that. However, I believe that multiple sources of income provide the ability to quickly and, most importantly, securely build wealth. If you lost your job tomorrow, you might have to dip into your savings or emergency fund. That wouldn't be ideal. Even worse, you might find yourself in debt. Having 2 or 3 sources of income helps you to navigate potential challenges like that with relative ease. In the history of time, there has never been an easier or cheaper time to make money. You don't need employees, nor do you need premises today. But the willingness to learn new skills and putting those into practice can help you build additional sources of income really easy. Taxes are one of the largest expenses in anyone's budget. As someone who is employed, it's very easy to assume that taxes are all but taken care of by your company, and for the most part, I'll agree that they are. As an employee, there are very few ways to legally reduce your tax liability, but this shouldn't mean that you disregard learning about taxes entirely. If you have a company car or other company benefits such as healthcare, do you truly understand the benefit in kind and how this affects your salary or the taxes you pay? Normal people don't. Wealthy people understand how investing in accounts such as pensions or ISAs shelters their money from taxation. All of these are beneficial to understand fully, even if you're an employee. For those who are self-employed or shareholders of their own companies, understanding taxes and how you can reduce your tax liability easily may be beyond your knowledge. I had a peripheral understanding of many tax elements that my business faced, but instead of going it alone, I paid accountants I trusted to manage this on my behalf. And I can tell you that they were worth every penny. And they helped us to navigate complex tax issues with ease. There is a huge difference between being cheap and being frugal. A frugal person will try to buy quality items, but will do so in a manner that makes it much more affordable. By using discount codes or waiting for a sale, they try and get the best price possible. The cheap consumer buys whatever they can find at the lowest price possible. Spending less on products or services may save you some money in the short term, but this often comes at the expense of longevity or quality. And more often than not, these items may need to be replaced more frequently, costing you more over the long term. If I was to talk about fast fashion as an example, buying cheap clothing will afford you a low-cost t-shirt or jumper to wear out this weekend, but after a few washes, the quality of the clothing deteriorates rapidly. The disposable nature of cheaper items means we don't think about the lifetime cost of one t-shirt versus many, but rather what it costs us here and now. Finding the lowest cost price for services often means that you get what you pay for, and this too can cost you much more later on. When picking insurance, for example, the cheapest option often comes with a higher excess or lesser coverage, which in the unfortunate case of an accident can cost you significantly more. Try not to choose a plan solely on the price, but based on the benefits coverage or other factors that may affect you and your family personally. You'll have friends who talk about money too much, and you'll have others who don't talk about it at all. But starting the conversation around money is the first step to understanding it better. Discussing money shouldn't be bragging about your luxury purchases, but rather talking about the topics that will benefit each of us. Pensions? Check. Saving money? Check. Reducing costs? Absolutely. Oh, look at my new Tesla? Not so much. You are the average of the 5 people you spend the most time with, and learning from each other is the best way to build your knowledge and to increase your awareness of certain topics. And talking about your finances needs to happen closer to home also. And many couples avoid this conversation entirely. In fact, the most common reason why we don't talk about our money is the shame or embarrassment that many of us feel about the state of our finances.
Shame.
Bearing all for your partner in the bedroom is often much easier than discussing your financial situation. But it shouldn't be. And talking about your finances and working it out as a partnership will help you to move forward together. Talking about money can reduce relationship stresses or eventual breakups, which are actually one of the most costly life events that can happen. Try not to get divorced. Never in the history of time has it been so easy or normal to access credit for purchases. When you shop online, almost every checkout now has a buy now, pay later option. Buying things and going into debt used to be reserved for high ticket items such as cars or homes. But when you can buy a £119 lawnmower for £5 and 1 pence per month, using debt to purchase everyday items has become much more normal. And I'll go back to the lesson I mentioned earlier. If you can't buy it in cash, you can't afford it. Save the money first and then go buy that item. Thanks, Dad. Of course, there will be some of you who are quick to point out that we'll pay no interest when you pay your full balance within 6 months. And that's valid if you're strict enough to ensure that this money is repaid in that time frame. But what if an emergency happened and you could not afford the repayment? Further debt is the answer to that. And I promise you, this wouldn't be an option on those sites if it wasn't used extensively by their customers. The credit companies are not your friend. And the fact that they present this offer so prominently on these sites means that many customers do not pay off their debt within 6 months and they are making money off them. The golden rule of budgeting and saving for your future is to pay yourself first. This means with every pay packet or wage that deposits into your bank account, you automatically dedicate a proportion towards your savings or investments. Treating your saving like a bill where it must be paid ensures that your money is put beyond the ability to spend it right away and goes towards your future. The problem with that is that it's normal that by the end of the month there's no money left and the saving and investing that you had planned never happens. Using your forward-looking budget, always assign a percentage of your income towards investments. And if possible, automate these investments a day or two after your salary reaches your bank account so that you can't spend that money. I know people who are the epitome of impulsive buyers. They see something they like and they buy it without a second thought. A few months down the line, they want something else and change it out or sell it, often at a cost to them. Being impulsive and buying things you don't really need can wreck your budget, because it's completely unplanned. It can be something as small as buying a packet of crisps, or it could be walking into a showroom and buying a new Jeep. Almost all of us have fallen into some sort of impulse purchase because we don't always think about the consequence, but rather the excitement of buying something new right now and the emotions that come with it. I am not telling you to stop spending money, but what I am telling you is to stick to your budget, and that will help you to avoid impulse purchases that will keep you poor. Thank you as always for watching my videos. If you're interested in earning more, saving more, or investing for early retirement, please do check out founder.co.uk, my website, where I have over 100 articles that will help you to build true wealth. Thank you for watching, and to play out today's video, I have a yet unnamed, unfinished track that I've been working on over the last couple of years, and I hope you enjoy it. See you in the next video. Bye bye.